Good afternoon, everybody. This is Jeffrey Scott. It is, as you can see here, September 27th, 2:40 p.m. Eastern Time Zone before opening of any futures markets, at least in North America. And this is my top-down review for today, September 27th, 2015. So I titled today, High Beta and Biotech Breakdown Lead to Extreme Bearishness. We are getting to levels of bearish sentiment not seen in this century, which in itself might be suggestive of a bottom, or at least a short-term bottom in the near future. Disclaimer, this is for education purposes only. Anything I recommend is in the spirit of education and not investment advice. I'm a doctor, not a broker. I am truly independent. I have no financial relationship, ownership of any software vendor. I have actually paid for all the products that I demonstrate, and no one pays me to say good or bad things about theirs or anyone else's software. Trading involves risk, and you alone are solely responsible for any investment decisions that you make. I've spent enough time on this in the past, but let me just say I consider my trading to be a marriage between CanSlim, CanSlim improved by Morales and Catcher, who used to work for O'Neill, made electronic and better by Ian Woodward and Ron Brown, and I married my CanSlim background with the teachings of John Person, who's really helped me from the perspective of when to take the trade, where to put my stops, when to take profits. The idea of a top-down investor looking at markets, industry sectors, and then stock is consistent between both those schools of teaching. I own a lot of programs. I purposefully try and hide my desktop during my presentations, so no one can really see all the programs I've wasted my money on, but I will tell you that these are the ones that I use on a daily basis. TradeStation and Thinkorswim for trading. Genesis is a great real-time platform, although expensive, and I suspect most stock alone traders don't make that investment. HGSI is a great analytic tool during and after market. EdgeRater is part of a family of products from Chris White, which I use on a daily basis. I am a big fan of seasonality. There's a lot of programs now out there. They're very competitive, and then multiple websites. So the first thing I like to do at the end of the week is to take a picture of my sector analysis workspace, which I adapted from one of the workspaces that John Person provides with his lifetime package. The first thing I thought when I looked at this on Sunday to prepare today was much more strength than I might have thought. If I look through here, no question, utilities are strong. They're defensive. Staples are strong. I guess they're probably somewhat defensive. If we look at REITs, they were strong on my weekend review, even with interest rates probably heading up. Because of higher rates, banks and insurers, broker-dealers also look strong. So there was a lot of strength in those places, and then weakness in social media. Healthcare, biotech got hammered this week. Airlines were a little weak on Friday, especially United, which I'm not sure what was special there about United, except it's in the major indexes. So we have materials were weak. So we have a mixture. Not all was bad. Now, if I look at the major markets, we've been in, I've commented several times that we've been in bear wedges and that we did have breakouts to the downside. And when I get into HGSI charts, it's a little bit easier for me to map it out. Now, one thing that was bothersome is on Friday, the green is a 17-day simple. And all the major indexes, which would be E-minis, NQs, IWMs, could be TFs if I changed it, are actually I got to fix that because that is IWM. It needs to be diamonds, and then the TFs here. But all of them ran up to their 17 days and reversed. Even the VIX ran up to its 17-day and reversed. And the dollar over here is in a narrow trading range. So we closed near the bottom on the indices after a very strong overnight session, which was a big reversal and worrisome. If I look at the week in Genesis, and again, E-minis, NQs, TFs, NYSE, and YMs, one can see we are in weekly sales, we are in daily sales, and there's really nothing optimistic looking at this, and one wonders if whether or not we are on our way down for a retest of these August 24th lows, and hopefully not the October 14th lows, which would be even further. Now, Janet spoke and rates creeped up on the week. They were up 2.25% or 0.45 or 45 basis points. This has been sort of a trend line that we bounced off. We're continuing to run back up here. And here are some previous, on the last run up, this was where we hit resistance. And the prior time run up, we hit resistance there. Frankly, I think the stock market would be happy to see us living in between 2.5% and 3% rates, because that would suggest still in a soft interest rate environment, but consistent with an increasingly strong world economy. The times that we've had the biggest dumps in interest rates have occurred during periods of time questioning the strength of the economy. Now, the AD lines continue to be horrible. Here is the weekly AD line. There's nothing optimistic about this picture. And you could see on the daily a sense that we were coming back up to test up here. And just as we've had 1, 2, 3, and now 4 times, we failed before reaching the 50-day moving average, and the daily AD rolled over again and is heading down towards new lows. So not a lot on the AD to make me happy. What about participation? Stocks above the 200-day SMA. We are now down to about, we're heading back down to where we were, and we're consistent with where we were in 2011 and 2008. We could get a whole lot worse if this mimicked 2009. If I look at stocks above the 40-day moving average, you could see we're at a point where most of the recent pullbacks in the market, except for the big bear market of 08-09, where we started to see reversals. So they can still get lower, as evidenced by the big bear. I think perhaps the bearish sentiment has gotten ahead of reality here and would be hoping soon for a bounce. Speaking of bounce in markets, one thing that I've learned from John Person is that October is a historically strong month in the market, and it would not be unusual in the month of October to see a major low put in, and then perhaps somewhat of a run-up into year end. As people know, I like to look at the canaries to give me a hint of what the market will do. The canaries have essentially failed at the 50-day moving average. Excuse me, I've got to go answer that. 1 second, let me pause. So about that, I'm back. So I look at the canaries to give me a hint. So they failed at the 50. Notice how the 50 earlier this year was support. So now it's become resistance. Essentially with this, quote, ice hole failure, it might not be too surprising to see us come back and retest. Again, not quite the August lows, but maybe pull back to the 200. Now, the NASDAQ 100 stocks, of which several of them are in the canaries, have been big market leaders. If these are truly rolling over, that says poor things for the market. Then again, the way this market's gone, some good news, and we could see them break out and lead the market higher. For now, I have to be a little bit nervous because it looks like it's failed the 50. Market thoughts. We've been talking for several weeks about bear wedges and blue ice failures on the Russells and the NASDAQ, suggesting a retest of August lows. I don't think I take that off the table. Many, if not most, individual stocks are in deep corrections, and many of them are approaching bear territory. I did see strength in certain areas, utilities and REITs, and banks, especially regional. Somewhat confusing because rates did creep up, which would be better for banks and insurers and less good for utilities and REITs. It may be people are looking at the big dividend yields in those two, as well as tobacco as being a defensive story. And in addition to what I've already mentioned, airlines continue strong. Longer term, is this continued topping, or is this just a deep correction in a QE world and the QE will prevent us from a deep bear and we're about to eventually bounce and head back up and ultimately to new highs. I can't tell. Eventually, it will be topping. The Fed is really in the hot seat, and I think we saw that this week where Janet came on to quiet the markets by actually saying rates are going to go up this year. And it's interesting how just a few months ago this would have brought the markets down. Risk management remains prudent. Small position sizes, less positions, potential collars on existing positions. We are getting close to when you might expect a bottom, but I've been saying that for a while. And, can some type of a retest set up a run into year end? That would certainly be a positive. Remember, stock patterns are cyclical, and until proven otherwise, we are somewhere here, and we're looking for any evidence of stability and done going down before I start worrying about a new big rally. Therefore, that means I start looking over on this side of the equation and looking at bearish strategies, bear call spreads, buying puts, selling calls, shorting stock, and contra ETFs. That's not to say I don't have any longs. Most of my longs at this point are protected, collared, etc. And I will consider additional longs, but most of them will be in defensive type holdings, as well as longs on contra ETFs. Know your news. There's actually quite a bit of news this week. Things that I think will be most important, the unemployment rate and the payrolls, which will be out on the 2nd. Some construction and auto sales on the 1st. Throughout the week, there's some energy inventories that will be important. The Chicago PMI, mortgage index, consumer confidence, a lot of things here that could be market moving or interrupting. Not much in the way of earnings, one of my favorite stocks for the week, that did not make my stock of the week because earnings are coming out before market opens on Monday, and I didn't want to leave myself hanging there with a potential disaster or gap away, would be CALM. Chart of the week. I'm going to review last week's chart. I have a bear pick and I have a bull pick for this week, but I'm going to hold them until I get closer to the end. As I've said before, these stocks are presented for educational purposes only. Trading, especially options, carries substantial risk. I do not warrant any expectation of return, and I may or may not have a position in these stocks. I do plan on taking trades I present so I can discuss on the following session, and I am doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I would plan on taking profits or placing stops. Last week, we picked CCRN, or cross-country healthcare. You all know how the week turned out in healthcare, but let's take a look at what CCRN did. There were a number of reasons why I like CCRN. First thing, I like the fact that it had growing earnings per share growth. I like the fact that my bongos and my force index had turned green. I like the fact I had a mobile breakout from a squeeze and a PSAR reversal on the prior Friday. We were close, although I would have liked it even better if we pulled back to the 50. On a daily perspective, the relative strength had crossed above the relative strength of the S&P. OBV was heading up, and I had a nice big beefy kahuna. So what I said to do would be buy stop at 1462, which is the green line here. My first target was at 1620. My stop, the red target, at 1385, risking 77 cents or 5.2%. Here's how the trade went. Here's where the before, and you could see we hit my trade on the first day, closed right at my buy stop, and then Tuesday, Wednesday, we had big moves. Thursday, we went into what looks kind of like a climax move there, of which we hit my target, which I took half off, actually on the day before. When I saw this candle developing, I took off at the open on the following day, the second half. So I am out of the position, and we ended up having a low close doji on Friday, suggesting potential more further weakness. This is typical of the trades that I take, and that I'm looking for a setup. It has lots of momentum coming in, PPS signals, OBVs going up, And in this case, daily, weekly, and monthly bongos were positive. And on the day that we identified the stock, it had a pocket pivot, mobile breakout. It had a squeeze, PSAR reversal, and a kahuna force. So a lot of the things that I like to find when I want to jump into a position. You will see that the two picks that I have for this week, which will be coming later, I think are also very interesting. Now, that said, let's go take a look at the markets. We'll start in my, let's do my spreadsheet analysis. Usually I open this up first, but I forgot to, so I apologize. The new version of Excel looks like it might even be a little bit faster. All right, we'll start with end of week Friday to end of week Friday. So this is looking at the impact if I had bought my watch list, equal number of dollars spent per instrument at the end of day last Friday and sold at the end of day this Friday. I just use this as an idea of what's working and what's not working. First thing is I got 1, 2, 3, 4, 5 positive groups, and I got about 50 or 60 negative groups. That should give you an idea. This was a horrible week to be in growth. S&P 500 was bad at minus 1.36, the IBD 50 at minus 3.34, the HGS 100 at minus 432. Had my buys triggered, which they didn't trigger, down about 9%. And even the Vesta Woodward and Brown was down 12.79. My high beta watch list, which is about 160 stocks, was down 13.23%. So this was a very difficult week for the bulls, and one of the big winners was that cross country. Even if you held it into the end of the day on Friday, you still would have made 7.14%. on what was a very, very difficult week. Hindenburgs did not fire, but as I've said before, they're not going to fire until we get back up to new highs, and our NYSE new highs are still well below 2.0, so highly unlikely that we're going to see that trigger for any time soon. Interestingly, because of some of the strength in the market, although not in biotech or in high beta stocks, you could see that the new lows dropped to 4.1. 3 different buckets to show you today. Bucket number 1 is the S&P 1500. Remember what the buckets are. We look at each stock within its Bollinger Bands. We have a midline. So on the right here, that tells me what percent of stocks in green are above the midline of their Bollinger Bands, what are below. So 2/3 are below their midline. And then I look to see how many stocks are below the bands, how many are above the bands, and where the distribution is within the bands. So overall, the S&P 1500, 13% are below their lower Bollinger Band. If I look into biotech, 89% are below midway, and now over 45% of biotech stocks. So these would be all the biotech stocks in HGSI that have greater than $2 and greater than 150,000 shares. 45% are below the Bollinger Bands. At some point, we're going to see a bounce here. And then I mentioned high beta was bad. Similar, 88% below the midline, but only about 26% of high beta stocks are below their Bollinger Band. We are getting to a place, especially in those oversold areas, that it would not be impossible to start to see a bounce. If I look at the markets, I could see we've gone back to red, which is bearish. And I just want to look at seasonality. Start with the ETFs. If we looked at over the next month from now, for the next 4 weeks, Russell 2000, the European 350, the small cap 600, the mid cap 400s, the S&P 500, 100, 600, Russell 2000, and biotech, all are pretty much flat. So this is an improvement from the month of September, where over the next 2 weeks, most of them are negative. So if you go from -2 to 0, that means over the next 2 weeks you have weakness, But somewhere after that 2 weeks, which would be the middle of October, you start to see strength coming into the market. If I look at by month, let's get to where we are here. You can see the month of September, volatility is still goes up in December 9%, but it's kind of a 50-50 move. So September is a tough month. That's where we are right now. And if I look at October, you can see volatility only moves up 2%, 50-50 times it's up or down. Everything else is positive. And then when I start to get into the year end, we start to see VIX go down and the major indices start to go positive. So we are getting to a period of time where performance is going to start to improve. The other thing to look at, let me figure out what I did here. Yeah, nothing here to report on. All right, so be interesting to see if and when we bounce. From a stock perspective, there were some stocks that have some positive seasonality. This would be stocks that have at least 16 out of up to 20 years showing positive seasonality right now. And I'll show you some things in perhaps Seasonality Trader in a second that shows that there's a lot of strength coming into the market. And then if you look at over the next 1 month, Google, for example, has been up 8 out of 11 years, 11%. Ace Limited, one of the strong insurers, is up 17 out of 20, averaging 5%. Insurance companies, I said, are strong right now. So there is some strength coming into the market as we start to look out the next couple of weeks. In Seasonality Trader, if I look at the calendar and I look at September, and I set my settings to 10 years, 90% winning, or 85% winning, no, 90% winning, and I want at least a 10% move. Let's see if I find anything. That might be too tight. Well, it shouldn't be that difficult to see that from a seasonality perspective, and this would be September 3rd until the end of the month, which will be Wednesday, we see a whole bunch of red, and much more red than we see in than we see green. Now, for example, RAD, Rite Aid. Rite Aid, and let me just give you sort of a little tutorial here. The candlesticks represent the actual performance. The yellow and the green represent 10-year and 5-year seasonality predictions of what the market should do. So I look at a stock like Rite Aid, and I didn't prep for this, but it's kind of followed very much what the predictability was with the little run into these earnings up on the chart. Now, had I looked at this, or presented this, a better thing to see, I would have told you that it predicted starting September 17th, which would be a few days before earnings came out, I believe. Let's see, here's that earnings date. Yep. It predicted, at earnings rather, it predicted at earnings that 9 out of 10 chance the stock would drop by an average of 18% over the next 30 days or so. So, knowing that, I might have been inclined to short the stock going into earnings. It was outside the linear regression lines, clearly in a downtrend, and the stock went from outside above down to a little bit outside below, and we've had a pretty substantial move down in Rite Aid. So seasonality can be very helpful, especially around earnings season. Now, if I look at August, I go to October rather, something changes. We now start to see a lot of green. So this is a period of time where we might see some strength in the market. And I just want to point out a couple of things here. Let's take a look at ALK, also known as Alaska Air Group. Alaska Air Group has been a leader this year. It's in a rather tight pattern here. Its earnings come out October 23rd, But if you look at 10 years worth of data, we see just make sure that that I have 10 years worth of data. Yep, we have 10 years worth of data. We see that if you buy on October 8th and hold it through November 18th, you would have been right 9 out of 10 times, with an average return in the positive years of 19.7% and minus 1.7 on the year you were wrong. So as you look at stocks to be thinking about right now, Alaska Air looks interesting. What else might be something that is a popular stock this time of year? I'm into Ozark as one of my favorite regional banks. So if we look at Ozark this time of year, right now it's not a strong period of time, but when I get into November, it's got a 9 out of 10 period of time, average return of 11.5%. So I might want to put that on my calendar and thinking about getting it in sometime before November 5th. And it's given me that notice about a week before I would have to make that move. You might see Deckers here. So from a seasonality perspective, this year has been dropping. This is unusual, so that might kill this analysis. But if I look at Deckers, I see that somewhere around October 23rd, I go into a 9 out of 10 positive time with an average return of 21%. And then not to leave out Apple, Apple's got split issues there. Let me load Apple again and see if that data error is fixed. Nope. Until they correct the data, it's going to make this look very compressed. So I'm not going to say anything about Apple except, to be fair, let me go into Magenta Trader, which is the other product out there, and let's see if we can see anything about Apple in Magenta Trader. Magenta Trader and Seasonality Trader, the proprietors, that's not good, used to be partners. And there's a lot of negative related to the breakup of the relationship. However, the positive is it's forced a lot of innovation as the two companies have become competitive. So let's just launch the software. Type in Apple. Yeah, I was thinking that Apple's got a strong period of time coming up, so let's take a look. So, Apple starting on October 13th. So again, put this down in your Outlook notebook that you want to be looking in your calendar at Apple sometime the week of October 7th and see if we've pulled back into support, and you might want to take a flyer. Why? Because you could see over on the left where it says 30-day scanner that Apple up 9 out of 10 years or 13.64% from 30 days from that date, and you could see to get the 9 out of 10 you had to hold it 40 days. So that'll be interesting to see. Now, a negative thing would be if I look at this, it looks like a lot of the positives came in the first 2 years, but last year it was up 15.47. So Apple also has some strength this time of year. If you like what I just showed you in seasonality, go to either seasonalitytrader.com, magentatrader.com, see about taking some kind of a free trial and see for yourself what you think. No, I'm not going to close that just yet. Now let's go into TradeStation and take a quick look at signals around the major indexes. So remember, I'm really looking here at just a couple things. I'm looking at person buy and sell signals. Obviously, green's buy, red is sell. I'm looking at Elder's impulse indicator, which is coloring the paint bar. Red would tell me that I should be shorting or holding. I should not be going long. Green, I should be going long or holding. I shouldn't be go short. Blue means I can do whatever I want to do. I've got daily, weekly, and monthly. If I see little dots at the end of the price bars, red would mean MACD divergence to the downside. Green would be MACD convergence to the upside. And that's what I'm going to concentrate on today. So let's start with the NASDAQ. Sell signal daily and weekly, NASDAQ clearly weak. Dow Jones Industrial in a sell signal on daily, weekly it's in a blue sort of dealer's choice. OEX or S&P 100 in a daily sell signal, weekly sell signal, blue on the Elder indicator. Semiconductors sell, blue on the weekly. Spiders, the cash market sell, blue on the weekly, same as the E-minis, although the E-minis actually have gone to red on the weekly. So this is all very bearish, and even when I see something that looks like this, I have to have a lot of caution because my daily and my monthly are in sell signals. So the fact that the weekly is still blue is nice to see, but I'd expect the first thing to turn if I'm going to start to move up would be the daily, followed by the weekly. So the fact that the daily is still short, I'm still not going to jump and go long this market yet. NQs, same old, red across the board on a sell. YM, person sells, red with that weekly blue. And then the Russell futures, red across the board. The IWM, for those that don't pay for futures, looks exactly the same. The diamond should look just like the YM. And then the Qs, the NASDAQ 100. So I look at these very quickly. I see, yuck. I see a lot of negativity. I see no compelling reason to go aggressively long right now. Very quickly, look at the sectors the same way. Materials on a sell signal. Been on a sell signal from person back in June. Really got people out early. XLE Energy. Now, it's on a sell signal. It's blue weekly, and it's got these green dots on the weekly, which suggests that we're getting to a point where the divergences may suggest a reversal is near. But it can take a while. XLF, the financials, actually had a buy signal come in on Friday, so hold the fort. We actually have a buy signal somewhere. That would be XLF, blue on Elder, blue on the weekly, still in a weekly sell. Industrials, sell in red across the board. Technology, sells blue on the weekly, but on person sell signals. XLP staples, hold door again. Another buy signal came in on Friday, and we went to green on the Elder indicator, blue weekly. Still lagging monthly, but this is consumer staples. Now, does it surprise you that finances and staples have turned positive during this period of time? No. If interest rates are going up and we need to play defensive, those are two popular sectors to play. Utilities. Oh my God, another green arrow. You got green paint bars, blue on the weekly. You can see the divergences led to the reversal here. And we've got buy signals on utilities. Utilities, financials, and staples. Healthcare got hammered this week. It's still within the Elder envelope. It's negative on the weekly as well in a buy signal. It's been in a buy signal now for several weeks. Or excuse me, sell signal, sell signal for several weeks. And then XLY, discretionary in a sell. So what do we see so far? Markets in general are weak, and sectors such as finance, staples, and utilities might be where it's at for this week. Now let's jump into HGSI and talk about what I see going on there. So I'm going to go down to user groups, Woodward and Brown, Major Markets Plus, and let's take a look. Sorry, my wife just came in and saw that I bought treats. Oh, my wife sometimes forgets. Sorry for that. Let's take a look at the S&P 500. We had a great PUG meeting on Thursday, and just want to show you what I was showing them. There's not a kahuna here, so let's just go into these simple views. What I told at the PUG meeting, and this is the line here. So let me clean this up. If you haven't seen some of the new add-ons to HGSI that will be coming out, you'll like to see this too. So George has updated the annotations quite a bit. So what I drew last week on the PUG group meeting, I said, here's the line in the sand. We've broken down from my wedge, my bear flag, whatever I want to call it, and I'm not going long this market until I get back and break up above that wedge. That's not to say there might not be some short-term plays, but for me to really believe the market is turned up, I'm going to have to trade up there, because right now my belief is we're going to do this at best and come back down here. So until I break above this line, until I take out this trend line here, I will not be bullish until I close above it. So until I close above that, I see no reason to be going all in long. So bearish on the S&P, and you're going to see that same pattern everywhere I look. Let's take a look at the Dow Jones Industrials. Kill all my old stuff. Let's just put this right in. I don't care where I draw it from. We broke down below support. Let's take a look at the NASDAQ 100. And you notice I'm not really using that deep 24th day. I'm kind of looking where it closed and where the low of the next day. We broke the wedge support there. And if I look at the Russell 2000, don't want to sound like a broken record, but I broke it there. Until we break above that line, it will be very difficult for me to believe that this market is turning around. If I look at the VIX and then the dollar, we'll start with the dollar. Dollar is kind of in a squeezing area here. I'm not sure if it's a real squeeze, so let's open up that view. It is. It had a mobile breakout allegedly on Friday. It did gap up there. I thought it might be a squeeze just because it's tightening up here. The dollar still has to get above the 50. If we're going to truly be raising rates, then I expect the dollar to go up. Volatility. Volatility is, I hope this is not the new norm. And if the market is in trouble, we'll expect volatility to go up. And I kind of look here, kind of a climax run, a pullback to support. Strong day on Friday. I think there's a high chance that volatility is going higher. If I look at gold and silver, gold had a good week. It looks like it's wanting to move up. That might be defensive. Keep in mind that, as I've said before, gold is in a pretty terrific downtrend and has a lot of overhead supply and resistance to get through. And if I look at silver, similar picture. So not a pretty picture in the markets. A short-term bounce is probably close. That said, I do think it's a retracement and not necessarily a breakout until we get above that wedge, the bottom of where that wedge was, which I think will be, at least the first time up, resistance. Take a look at 07 industry groups. Let's bring this now. You know what? Just to show you, because I didn't really pay attention, I should have looked at this in top-down view, and you would have seen that for the week, utilities, gold, lead, small stocks, NASDAQ lagged. And that's no surprise, and especially with what happened on Friday. If I go to '07, and let's see where the strength in the market was, banks, utilities, precious metals, banks, utilities, I guess this will be like trust banks, life insurance, wealth managers, beverages, home builders, rates are still low, a bunch of insurance companies. If I look at where weakness was, telecom carriers, consumer e-commerce, discretionary, steel, electronics, defense. If I expand my period of time over 5 days, biotech, specialty pharma, oil exploration, medical devices, large pharma, midstream, semiconductors, oil, gas services were hammered over the 5-day period of time. If I look at up moves over the last 5 days, utilities, banks, and the metals. So let's take a look at some of these moves. Diversified banks. So you look at these charts, this is pretty beaten up in Bank of America. But if interest rates are truly going up, you might expect to see this move up. It's going to have to get through 16.5, which is the 200-day moving average, but it doesn't seem to have been much in the past to get through that. Earnings per share are coming in to Bank of America. It has a small dividend, and it's one of the 3 or 4 large U.S. banks, and it did have a kahuna. Not a great-looking chart, but probably going higher. Same thing with Citigroup with the kahuna, also has to get through the 200-day moving average. JP Morgan, probably a little bit stronger as it did not knife nearly as far below. It did have a kahuna turning up as well. Big gap up on Friday. And probably got to have Wells Fargo here. Here's Wells Fargo, same pattern. I think that banks are starting to go up, and if we truly have rates going higher, both the big banks and the small banks are going to play. Here's some utilities, integrated utilities. Southern actually made my list for a couple reasons. It makes money, does have growth in earnings. It had 2 kahunas last week on Thursday and Friday, as well as one on Monday. It did break above the 50-day moving average, had a mobile breakout of a squeeze. Now you look at this, it's hard to say that any of these have been in uptrends. In fact, they've all come back down hard, but this might be more indicative of what these stocks do. And you look at last year, they started their run up in October. I guess you could even go back and say, yeah, September, October, and then they fall after February. And that may be what it's doing again. Run up in October, here fell after April. So maybe it's utility season. I like Southern. Exelon, a little bit deeper pullback. PEG ran all the way up to the 200 and pulled back, did have a kahuna and a MOBO breakout. Duke's another one, looks a lot like Southern. So you have integrated. WEC was another one that made my list. This one may have one of the better chart patterns. Again, makes money, pays a 3% dividend, and broke above the 200 with pocket pivots. You can see OBV broke out as well. So electric or integrated utilities, precious metal mining. So I guess as a defensive play, you can look at AEM. Nice move off the bottom with a kahuna on Thursday, coming out of a mobile breakout of a squeeze. Everything turned green. It makes money, pays a small dividend, high multiple. American Barracks bouncing off the bottom. Newmont bouncing off the bottom. Goldcorp bouncing off the bottom. Stillwater looks better than the last 3. Doesn't look as good as AEM. Breaking above its 50 with a bunch of kahunas this week, more of a silver play. So gold and silver may be in fuego as defensive plays. Regional banks. There's a lot of choices here. They've been pretty much beaten down, and this is not an unusual pattern with a nice gap up on Friday. Kind of looks like Bank of America. KeyCorp, SunTrust, Fifth Third. First Niagara actually was a big mover, had big volume coming in. Let's see if there was any news on First Niagara that might make it different than the others in the group. I guess talk about takeover has made First Niagara move. The one that I've been playing, as I mentioned earlier, is Bank of the Ozarks. Let me just type in OZRK. To me, it looks better than the others. It's got earnings per share growth, pays a small dividend. It's above its 50-day moving average. And then one way of playing this group may be not to pick favorites, but just go with the ETF. This is KRE. You have KRB, which is the bigger banks, I believe. Not K. I thought it was KEB. Well, forget that. KBE, my bad. There's another way of playing it. And this would be different than playing XLF. That includes a lot of other things besides banks, but all of them look like they might be moving, or many of them. All right, utility networks, so more utilities, PG&G. Breaking above the 200, lots of pocket pivots, volume coming into the stock, decreasing earnings per share growth, pays a nice multiple. PPL, again, below the 200, 4.7% dividend, decreasing earnings per share growth. But you can get an idea here of how much OBV has picked up over the last several weeks as money is going into defensive plays. Sempra Energy, probably a low-risk time to buy the stock. Earnings are not out until 11/3. It pays a 3% dividend and coming off of what might be some time of intermediate low, and making higher lows as it moves back up. So when I start looking at banks, utilities, and metals, obviously not an aggressive time to be in the market. A couple of the big trust banks made the list, though these are a little different. Here's BNY, probably a place that you'll be happy if you bought BNY, pays a small dividend, had a kahuna come in on Friday. Northern Trust, similar looking pattern, gapped up on Friday with the kahuna. And the third one here is State Street. Again, gap up on Friday. You're buying them after pretty deep pullbacks, especially on that famous 824 day. Probably more evidence of defense in rising interest rates. Life insurance. Another potential benefit, MetLife. The charts don't look that great, so I'm not even saying anything. I thought I saw some things that I liked here. No, really not. Must have been more other insurers. Wealth managers. I did like, well, we'll take a look here at a couple of these. Interactive brokers I thought looked great. Charles Schwab. Looks like the banks with gap ups on Friday. E-Trade, TD Ameritrade. Next group down, beverages. Those are always defensive plays. Coca-Cola, Anheuser-Busch. Kahuna up, failed at the 50 on Coca-Cola. I might want to wait till it got above the 50 before I decide to go chasing it. Anheuser-Busch, certainly looks like you're buying it off of a new base here with a kahuna. If you follow John Person, this is a high closed doji, which is a very bullish signal. PepsiCo, pull back here with a kahuna. So beverages seem to be moving. And then mass merchants. So it's going to be Dollar Tree. Looks like it's bottomed. OBV's heading up. Big Lots, one of the best charts of the bunch. It's certainly been a bearish chart, but now breaking above its moving averages. Pretty soon you'll have the 50 cross the 200. OBV's turned up. It had a pocket pivot this week. Everything green up here actually looks pretty darn good. Costco, similar. 5 below, less so. So I'm sure you got your list out and you found hundreds of things to buy there. I'm joking. A couple other things to look at. Home builders. You know, this is D.H. Horton. In an uptrend, it's above the 50. It doesn't look like a great candle on Friday, but it actually was up 0.5% on a very bad day. Standard Pacific, similar pattern. I think KB Homes or somebody had earnings out earlier. Toll Brothers was up on the day. The one that I've been looking at, this is the leader right now. Now, I don't like Friday's candle, the shooting star light candle. That's not a candle that I see and I feel bullish about. So I would be looking, probably playing D.H. Horton. Refiners, Tesoro was my call when I did my program on Wednesday night, but the first 3 or 4 or 5 may look interesting. Holly Frontier, uptrend now from 30 up to 50 since January, broke above the 50. Volume coming in at Kahuna on Thursday, coming out of a mobile breakout from a squeeze. That looks viable here, 2.7% dividend, nice earnings per share growth coming in. Valero, not quite as good, it's below the 50, but maybe not a bad point to be considered nibbling. Here was my pick on our Wednesday call where I thought that Tesoro looked good. Similar to Holly Frontier, good earnings per share growth and a 2% dividend. All right. We'll talk a little bit about how I find stocks to short, go through my buy and sell of the week, and then go and take my dog out to potty. Sounds like fun, doesn't it? I do a number of different things to find stocks to short. There is a HGSI member, Chris Wilson, and he gave me some views a while ago. And as I look at things to short, and let me get something that, let's take a look at RIG. And I think that's about where I want to be looking. All right. Those who've only been trading for a while know of RIG as a rather inexpensive stock that's probably having challenges paying its dividends. But if you were trading in the beginning part of this decade, you would know RIG as a stock that ran, well, I could go even later, but from September 04 in the 30s by June of 08 at over $150. That's a big move. Now, you could pick periods of time that you might have wanted to get out of the stock, but how do you know when it's time to get out? And what Chris introduced us to was this view. And what was cool about this view is it incorporated some very neat things. It incorporates 3 weekly moving averages, a 10, a 21, and a 40. And then he came up with a way of looking at the relative strength of a stock versus a comparator, in this case the S&P 500. When the red is above the blue, the stock is outperforming. When the red is below the blue, the stock is underperforming. And what you could see is during the big up move, not only was the stock pretty much always above the 40-week moving average, it was almost always above the 20-week moving average, and it never crossed below the S&P. Then we get to this point here, and what you see is several things has happened. Over a couple of weeks, the stock knifed through the 10, the 20, and then ultimately the 40-week moving average. The weekly bongo went negative, and we started to see kahunas to the downside. Now, you might look at this and say that the cross in relative strength was late, so maybe it's not a great way to find shorts. But I will tell you that this here is what I now look for shorts. I could look up earlier here, but I won't take the short until I see a breakdown in the relative strength. So what happened from this point? So this would have been my short opportunity. This retest the next day or next week confirmed it where it failed to get above on the relative strength, and the rest is history. Now, you notice here most of the damage has been done. So you went from really taking the short on this day here. So if you got into the worst part, about 130, and then when I get over here, I had crossed over the 10 weeks, so that might have been evidence. I broke above the relative strength here. I broke above the 20-week there, but somewhere around 66. So I would have had about a 50% move had I taken that short. And now I would be out of my short position, especially when I've gotten green on the weekly bongo. A lot of choppiness here until this bar came in. On this bar, I failed at the relative strength line, have my kahuna, my bongo, and I broke below the 40-week. I'm taking my short again. And not saying I wouldn't have been stopped out, but I could have gotten back into my short position somewhere in this range right here, maybe even a little bit sooner. So it's that constellation of breaking below major moving averages, getting a weekly bongo, a kahuna to the downside, and the relative strength of the stock breaking below that of the S&P 500. That's been my go-to signal for shorting. So much so that when I look at stocks, and I was going to make something into a slide that I can't show you right now, I actually have that view sitting there on my desktop, making sure that the relative strength on a weekly basis is better than the index that I track. So I had a nice conversation with Chris from EdgeRater and said, Chris, can you make me a shorting template? And can you plot some relative strength comparison versus the S&P, look at various weekly moving averages, and calculate a relative strength of my stock compared to that index? And if you can do that, maybe we can find good things to short. So then I would pick a universe of stocks to short, and I'm not going to give away all my secrets tonight, but I guess I can't because I didn't put it in here. Let's say that in HGSI, I have created a list that I prospect from, and for the long side, I prospect for weekly bulls, but this is my weekly bears. So let's copy ASCII utilities to lists. Okay. So that's going to put that list now within EdgeRater. Now I'm going to come down here, find my weekly bears, and I'm going to do a quick update. Updating just this directory, which has probably got about 1,000 stocks in it. That was quick. And now I'm going to come over to my shorting template. I'm going to run it. I'm going to hit run and have a drink of my coffee. Oops, it's short. No, it's the short stocks. Weekend shorts. All right, I ran this earlier today, and this is what I came up with. And I went through and I found a couple things that I thought were interesting in potential shorts. So let's look at closes. Yeah, that's better. Closes greater than or equal to 50. So I only want to have expensive stocks. I don't like shorting cheap stocks. Okay. And I like them to have crossed below one of the moving averages today. So all of these will have crossed below, and I only want them to have crossed below on the 20. Now, And then I'd like them to have crossed. All right, so this would be, let's look at Prothena. By definition, Prothena is a stock that today crossed below the 20-day moving average and its relative strength went short. It had a big kahuna to the downside, and it's in a bongo to the downside. So let's take a look at that chart. This is called PRTA. And you could see, here's a stock that's had a run-up, hasn't quite through, there's a different calculation between how Chris did it in HGSI and Chris in EdgeRater, but I found the stock that's broken through the 20-day, not yet the 40. It's about to break through or cross through the relative strength line, and this is one that may be a potential shorting candidate. Now, the one that I like the most as a shorting candidate for this weekend, and that'll lead us to the charts of the week, is Edwards Life Sciences. And the reason why I like this one as a potential short had to do with the fact that it broke through the 40-week, had some kahunas to the downside, and is in a weekly bongo to the downside. So we'll come back and look at that in a moment. So basically, I find shorting candidates by looking for the opposite of my longs. I might look at my list of stocks that's been moving to the upside, and when the market rolls over, those might be some that fall the hardest. I might run various scans in HGSI and certainly in EdgeRater, and I try and build a watch list of stocks that meet my shorting criteria. Now, in the SMART groups, under my name, you have squeezing potential PSAR reversal to the downside. This is a place where I might find short candidates. I might find them here with MOBO breakdown, stocks that had a MOBO breakdown today. I might find them here breakdown from a squeeze. So there are a number of different things that I might look at to find shorting candidates. And also within EdgeRater, you have George Lee's breakouts and breakdowns in a squeeze, and you also have M&K, Code Blue, and Code Red. Let's go back before I finish and talk about the charts of the week. So once again, as I've said before, these are presented for education purposes only. Trading, especially options, carries substantial risk or loss. I do not warrant any expectation of return, and I may or may not have already have a position in stocks presented. I plan on taking the trades that they execute so I can discuss on the following session. And I am doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I would plan on taking profits or placing stops. So, bullish position for 927, RAI, Reynolds American, which is not aluminum, but rather tobacco. To be honest, I have some mixed emotions about tobacco, being that I'm an oncologist. However, I will point out that my forces and my bongos have all gone green. I'm coming out of a MOBO breakout from a squeeze. I am sitting just above the 50-day moving average. My relative strength daily has turned up. I have a kahuna, and I think this stock looks good. It's got earnings per share growth that pays a 3.3% dividend. If I look at in TradeStation, I also notice that it's in a PPS weekly buy, had a new daily buy on Friday. The OBV is above its moving average and trending up on the weekly and the daily. All three bongos, daily, weekly, and monthly, are positive. And as you could see here on the daily, it's got had a MOBO breakout and a squeeze. Its PSAR is underneath the price, and it had a kahuna force. So I would, if the market is stable, so if the market's going up, a lot of things will work. This will work too. If the market's dropping hard, this may work better than others because it's defensive, but I certainly wouldn't be jumping in with everything if the market is falling hard. But if the market is not falling or moving up fast, I have a buy at 43.05. My first target's 46.50 and the second's 49.05. My stop is at 41.85, assuming risk per trade. I'm willing to take as $2,000. It means I'm putting at risk $1.20 per share, or about 3%. Therefore, I can purchase about 1,600 shares. Here is my target 1, my target 2. There is my stop. My stop is right below the last conditional change and really looks at the lowest low in the last 7, 8 or so days. So if Reynolds American moves up in a orderly fashion, I will be going long on Monday with my stop as noted. To be fair, this could be a tough week, and I'd like to point out here why my short opportunity, again, as I mentioned earlier, appears to be Edwards Life Sciences. We've been in a gradual uptrend for most of this year. On Friday, my bongos turned negative. My forces turned negative. I have a mobile breakout from a squeeze. My PSAR dot went to a sell. My relative strength versus the S&P moved below, and I had a kahuna to the downside, meeting my criteria that I prefer. On my trading plan, I noticed that I have a PPS weekly sell and now a daily sell. My OBV is below the moving average on the weekly and the daily, and they're both trending lower. My histogram is heading down on the daily. That's something for another day. My bongo daily and weekly are in sell, although my monthly is still in buy. I'm in a squeeze with a mobile breakdown, the PSAR sell signal, and a forced kahuna to the downside. I have two choices here. I would sell it at 136 1/4, my target being about 125, which is down here, side of a previous last conditional change. My stop would be up here at the high of this day, which was 144.90. If I can risk $2,000 per trade, I'm looking at risking $8.65 per share, or about 6.3%. I can therefore short about 250 shares or buy 5 $135 October 15 puts at $4 a pop. Now, I just looked at spending that $2,000 on the puts, and that assumes no money management. I could certainly buy more puts and have a stop on my puts as well. Bottom line, this is a week where I expect the market to trade down, barring some great news event that says go for it for the bulls. I do think we're getting near a reversal time, of which I'll be looking for. But I've given you a short and long opportunity. So we've now gone through what I wanted to review. Just to remind you, October 16th to the 18th, Greg Mills, Orange County meeting, headlined by George Lee. I'll be one of the speakers. October 24th through 26th, PV meeting with Ron Brown, Ian Woodward. I will not be there. And then I will be speaking the following weekend back here in Palm Beach Gardens for John Person. You all have a great week. Be safe, and see you soon. Thank you.